Welcome to CoreLogic RP Data's update on housing market conditions for March 2015, brought to you by Credit Union SA. Last month we saw mortgage rates cut by a further 25 basis points, taking the average discounted variable mortgage rate down to 5.7%, which is the lowest mortgage rate since 1968. This was the first cut to the cash rate since August 2013, but the 8th cut since the Reserve Bank started easing the interest rates back in late 2011. On the back of lower interest rates, we saw auction clearance rates surge to their highest level since 2009. Sydney has seen auction clearance rates at 80% or higher over each week of February, while Melbourne clearance rates have been at 75% or over the second half of the month. Additionally, we saw the level of industry activity surge to new record levels across the CoreLogic platforms. Valuation events surpassed their previous record high in February, and the number of real estate agent pre-listing reports also hit new highs across every state and territory except for Canberra. Dwelling values also moved higher over the month, with our combined capital city index increasing by 0.3% in February, taking dwelling values 1.6% higher over the first 2 months of the year. The recently stronger housing market conditions have also pushed the rolling annual rate of growth higher after the annual rate of growth had been moderating over the second half of 2014. Capital city dwelling values are now 8.3% higher over the 12 months ending February 2015. Australia's largest city, Sydney, is still leading the market, with dwelling values moving a solid 1.4% higher over the month and 13.7% higher over the past 12 months. Melbourne remains the second strongest capital city housing market, with dwelling values 7.4% higher over the year, followed by Brisbane, where values have moved 5.9% higher. The weakest performing capital city is now Perth, where values have moved just 0.6% higher over the past 12 months, while Canberra, Darwin and Hobart have also recorded an annual rate of growth that's less than 2%. With the pace of growth in dwelling values remaining substantially higher than growth in weekly rents, rental yields are continuing to reduce. A year ago, the gross rental yield for a capital city dwelling was averaging 4.3%. By the end of February, the typical gross yield had eroded to just 3.7%. Over the current growth cycle to date, we've seen capital city dwelling values rising at more than 3 times the pace of weekly rents. The byproduct of such strong capital gains and relatively weak rental growth is that rental yields are being forced lower and lower. The lowest rental yields can still be found in Melbourne, where the typical house is showing a gross yield of just 3.2%. However, with values growing quickly in Sydney, it might not be long before Sydney takes over the mantle from Melbourne as the lowest yielding city. Adelaide dwelling values are increasing at a pace that's only slightly higher than inflation. Over the 12 months to the end of February, Adelaide dwelling values were 3.4% higher, and over the past rolling quarter, values had increased by a relatively flat 0.8%. Similar to most other capital cities, house values are increasing at a faster rate than unit values. Over the year, house values have increased by 3.6% compared with a 1.7% gain in unit values. Rental yields in Adelaide remain higher than the national average, with a typical house providing a 4.2% gross yield and the typical apartment showing a gross yield of 4.8%. Looking forward, the big question is, to what extent will lower interest rates affect the housing market? The previous rate cuts saw auction clearance rates surge back to the highest level since 2009, and industry activity across CoreLogic RP Data valuation and real estate agent platforms has now moved to new record highs. Based on what appears to be an enthusiastic response from home buyers to last month's rate cut, it appears that home buyer demand has been re-energised by the lower cost of debt, despite the headwinds of weaker labour markets and softer economic growth. With mortgage rates potentially moving even lower over the year, it stands to reason that home values will continue to move higher to new historic highs. The Reserve Bank has previously stated that they will be looking towards the regulatory framework to minimise risk in the housing market, and it's clear that APRA are vigilant for any deterioration in lending standards across Australia's lenders. The buoyant housing market conditions should continue to support growth in housing construction, which in turn provides a strong multiplier effect on the Australian economy, with increased housing activity flowing through to more spending on items such as building materials, appliances, home furnishings and white goods. Once again, thanks for tuning into the CoreLogic RP Data Housing Market Update. We're constantly updating our blog and website with fresh housing market research. To find the latest updates, you can visit www.corelogic.com.au.